Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding ESG Investing, Trends, Challenges, and Future Insights. Governance Factors. Governance factors play a vital role in environmental, social, and governance (ESG) investing. Effective governance ensures that companies act ethically, uphold strong values, and foster trust among investors and stakeholders. By focusing on governance, investors can make informed decisions that align with their values and objectives. Corporate governance structures. Understanding corporate governance structures is essential for any investor. These structures outline how a company is directed and controlled, influencing its overall performance. Good governance can lead to better investment returns because it helps prevent mismanagement and unethical behaviors. Here are some key elements to consider. Board composition. A diverse board can provide a variety of perspectives that enhance decision-making. Look for boards with a mix of skills, experiences, and backgrounds. Independent directors. Independent board members are crucial. They help ensure that decisions are made with shareholders' interests in mind, not just the interests of the executives. Shareholder rights. Companies that protect shareholder rights encourage investment. This includes fair voting processes and clear communication about plans and strategies. Risk management. An effective risk management system can identify and mitigate potential issues before they escalate. This reflects a company's ability to protect investments. Executive compensation. Pay structures that align with long-term performance motivate executives to create value for shareholders instead of focusing on short-term gains. Each of these elements can significantly influence an investor's decision. Strong corporate governance can indicate that a company is likely to act in the best interest of its stakeholders. Transparency and accountability. Transparency and accountability are cornerstones of good governance. When companies operate openly, they build trust with investors and stakeholders. Here's why these factors are crucial. Open communication. Companies should share information about their operations, financial performance, and governance practices. Transparency allows investors to assess risks accurately and evaluate potential returns. Regular reporting. Frequent and clear reports on company performance keep stakeholders informed and engaged. This includes sustainability efforts, financial results, and strategic changes. Ethical practices. Companies that uphold ethical practices foster confidence. An ethical approach not only protects the company's reputation but can also prevent costly scandals. Stakeholder engagement. Companies should actively seek feedback from stakeholders, including employees, customers, and the community. This helps to align corporate actions with societal expectations. Have you ever considered how much a company's transparency can affect your investing decision? A transparent company is much more likely to earn your trust and your investment. In conclusion, paying close attention to governance factors can set the stage for better investment decisions. Companies that prioritize robust governance structures and clear accountability practices are more likely to create sustainable value for their shareholders and stakeholders alike. Challenges and criticisms of ESG investing. ESG investing, while gaining traction, faces its share of challenges. Investors want to make socially responsible choices, but they are often met with confusion and frustration. Let's take a closer look at two significant hurdles: greenwashing and lack of standardization. Greenwashing. Define greenwashing and explain its implications for investors. Greenwashing occurs when companies present themselves as more environmentally friendly than they genuinely are. It's a misleading marketing tactic used to attract investors who prioritize sustainability. Imagine a company painting its building green and claiming to be eco-conscious while secretly polluting the air. This deceptive practice can mislead investors, making it hard to distinguish between truly sustainable companies and those merely putting on a facade. Here are some implications of greenwashing for investors. Misinformed decisions. Investors may mistakenly support businesses that do not align with their values. This not only affects their portfolio but also undermines the overall goal of promoting sustainability. Loss of trust. When investors discover they've backed a greenwashed company, their trust in ESG investing can diminish. They may become skeptical of all companies claiming to be sustainable. Regulatory risks. companies found guilty of greenwashing might face penalties. If investors are tied to these firms, they could risk financial losses. Understanding greenwashing is crucial. Investors need to be vigilant and seek transparency to ensure their money supports real, positive change. Lack of standardization. Discuss the challenges posed by the lack of standardized ESG metrics and ratings. The world of ESG investing is rife with inconsistent metrics and varying ratings. This lack of standardization complicates the decision-making process for investors. Different organizations measure ESG factors in diverse ways, leading to confusion. Consider these challenges. Conflicting ratings. One firm might rate a company highly for its environmental efforts, while another might give it a low score for social responsibility. This inconsistency leaves investors unsure of where to place their trust. Difficulty in comparison. Without a common framework, comparing companies becomes a guessing game. Investors want to make informed decisions, but differing criteria make this nearly impossible. Limited data. In some cases, investors may find little data on specific companies regarding their ESG practices. This lack of information can hinder an investor's ability to make sound choices. The absence of a unified approach in ESG metrics creates a complex environment. Investors must sift through a myriad of opinions to discern what truly matters to them and their values. The future of ESG investing. As we look ahead, ESG investing is evolving rapidly. Investors are paying more attention to how companies address environmental, social, and governance issues. This shift is reshaping the investment landscape and creating new opportunities. Let's explore how technology and regulations can influence the future of ESG investing. Technological innovations. Emerging technologies are playing a significant role in how ESG investing develops. Many investors want to know exactly how their money impacts the world. Here are some ways technology is helping. Data analytics. Companies are using advanced data analytics to measure their ESG performance. This helps investors see which companies are genuinely committed to sustainability. Blockchain. This technology offers transparency. It allows for better tracking of supply chains, ensuring companies meet their ESG standards. Imagine being able to see exactly where your products come from, right down to the sourcing of materials. Artificial intelligence, AI. AI helps assess risk related to ESG factors. For instance, AI can analyze news articles and social media to see how companies are perceived regarding their social responsibility. This helps investors make more informed choices. These innovations can provide a clearer picture of investments. They can also drive more companies to adopt better practices to attract investment. As these technologies become more prevalent, ESG investing will likely become more streamlined and efficient. Regulatory developments. Regulations can significantly impact how ESG practices develop. Governments around the world are starting to pay more attention to sustainable investing. Here's what you should keep an eye on. Standardization of reporting. Expect more rules for companies to report their ESG performance. Consistent reporting will make it easier for investors to compare companies and make informed choices. Mandatory disclosure. Some countries are moving toward requiring companies to disclose their ESG risks and strategies. This will push companies to be more accountable for their actions. ESG regulations. Governments may implement stricter guidelines on what qualifies as an ESG investment. This will help ensure that funds marketed as green or socially responsible are genuinely making a positive impact. These regulatory changes could reshape the investment landscape. They will challenge companies to step up their efforts in sustainability and improve their governance structures. For investors, this means better tools to make responsible choices and potentially a greater return on investment in the long run. As ESG investing continues to grow, technological advancements and regulatory changes will play a vital role. The future looks promising for those committed to making investments that align with their values. Are you ready to embrace this new era of investing? ESG investing is more than just a trend, it's a vital strategy for a sustainable future. By focusing on environmental protection, social responsibility, and strong governance, investors can drive meaningful change while potentially maximizing returns. This approach aligns financial goals with personal values, making the investment journey more fulfilling. Consider exploring specific ESG opportunities that match your interests. As the world shifts towards sustainability, your investment choices can pave the way for a better tomorrow. What role will you play in this movement? Your decisions today can create lasting impacts for generations to come. Thank you for taking the time to explore this important topic. Share your thoughts and join the conversation about ESG investing. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.